All right, let's just jump right into this. Welcome to the investment committee meeting, everyone. Today, we are putting on our Warren Buffett hats, so to speak. We're going to conduct a really rigorous, fundamental value analysis on StepStone Group, which is a massive player in the private markets. Our goal here is actually pretty simple, though definitely demanding. We want to figure out if this is a wonderful business at a fair price, or if it's just a value trap waiting to catch the unwary. So grab your notepads, because we are going deep into the filings day.
Here is our quick roadmap for today. 1. Business and economic moat. 2. Deep financial statement analysis. 3. Valuation models. 4. Margin of safety. And finally 5. Our final Buffett-style verdict.
Okay, kicking things off with Section 1, Business and Economic Moat.
So to explain this in just one simple paragraph, StepStone is a huge private markets investment firm. They develop customized investment solutions, advisory, and data services. And as of their most recent quarter, they are managing a staggering $132.8 billion in assets. That is massive. They're actively expanding through these evergreen strategies, meaning funds that basically have no expiration date, on platforms like LSG's digital markets infrastructure. Plus, they have these exclusive data partnerships with firms like PitchBook. So in essence, they are selling access to and data on the whole private equity ecosystem.
Now, there is a really fierce debate out there over their economic moat. The bulls will tell you StepStone has a narrow moat built on its brand reputation and their proprietary SPI data intelligence, which is basically a benchmarking tool for private markets. But the bear case, and honestly the evidence in their own industry presentations, points much closer to none. Why? Well, because they face incredibly high capital requirements, elongated fundraising timelines across the whole industry, and some really intense pricing pressure, especially as spreads and direct lending compress so quickly right now. So, running StepStone through our classic Buffett checklist immediately raises a few red flags. Is it an understandable business? Yes, absolutely. Private market asset management. But does it have a durable competitive advantage? It's pretty weak. They're highly reliant on general market fundraising cycles. Do they have consistent high returns on equity? No way. It is deeply structurally negative right now. And what about able and honest management? Well, they are successfully expanding their assets under management and forming strategic partnerships, sure, but their capital allocation is super questionable given the massive disconnect between their growth and their actual profits.
Moving right along to Section 2, Deep Financial Statement Analysis.
Guys, here is the core problem staring us right in the face. Look at Q4 2025. Revenue was $377.7 million. Fast forward to Q3 2026, and the top-line revenue has aggressively scaled up to an incredibly impressive $586.5 million. But look at the bottom line. The earnings per share completely collapsed. They went from a 24-cent loss, widening out to a devastating $4.66 loss right in the middle of that run.
Over the trailing 12 months, StepStone generated $1.8 billion in revenue, but they somehow bled an agonizing $546.5 million in net income. According to Simply Wall Street data, over the past 5 years, their losses have actually grown at an annualized rate of 74.5%. Think about that. That is a severe lack of earnings consistency. Let's talk about their operating leverage for a second. By early 2025, StepStone's headcount grew 14% to 1,130 employees, and they're generating over $1.5 million in revenue per employee. Sounds fantastic, right? But wait, because of their massive cost structure, the actual profit per employee sank to a devastating negative $483,650. It is literally like adding more and more engines to an airplane that is actively losing altitude. The more they grow, the more money they manage to lose per person.
Full disclosure here, in the spirit of radical transparency for our committee, our source documents actually lack the full 10K tables for precise balance sheet strength metrics, like debt to equity or explicit free cash flow. But let's work with what we do know. To calculate owner earnings, Buffett takes net income plus depreciation and amortization and then subtracts maintenance capex. If we assume maintenance capex equals standard D&A, our owner earnings here exactly mirror that catastrophic net income loss. Plus, they're paying a 2.43% dividend yield. With a trailing 12-month EPS loss of $7.01, that dividend is completely uncovered by earnings. That right there is a massive, flashing red siren for any value investor valuing their capital allocation.
All right, let's jump to Section 3, Valuation Models.
Since we are missing standard 10K cash flow statements in our materials to derive explicit cost of equity and debt, we have to make some baseline assumptions. We'll assume a standard AAA corporate bond yield of 4.4% for our risk-free rate comparisons. And we'll use the current known share price of $43.94, which we sourced from ticker data in late February 2026, to anchor our valuation models.
So let's attempt our first model, the classic discounted cash flow, or DCF. Frankly, a traditional DCF model immediately breaks down here. I mean, to project free cash flow out 5 to 10 years, you need a positive base, or at the very least, a clear path to profitability. But with historical losses growing at 74.5% annually, any reasonable base, optimistic or pessimistic scenario just results in a severely negative intrinsic value. The perpetual growth method for terminal values simply doesn't function with fundamentally negative base cash flows.
Okay, so let's pivot and try the Benjamin Graham intrinsic value formula. Value equals EPS times 8.5 plus 2 times the growth rate times 4.4 divided by the AAA bond yield. Well, when we plug StepStone's trailing EPS of negative $7.01 into this formula, basic math takes over. Multiplying the rest of the formula by a negative EPS results in a mathematically negative intrinsic value. It completely voids any traditional margin of safety we'd look for.
Now, if we look at relative valuation through multiples, StepStone trades at a price-to-sales ratio of 2.8x. This is compared to a broader U.S. capital markets industry average of about 3.6x. Some might look at this and say, hey, it's cheap. But this cheapness simply prices in the market's deep concerns about their structural inability to generate a profit. The market is discounting the stock because a 3% revenue growth expectation absolutely pales in comparison to the industry's 10.2% growth, all while they are carrying massive losses.
Section 4. Margin of safety.
Let's take a look at the market reality right now. The stock is acting like a falling knife. It had a 52-week high of $77.80. It closed out 2025 at $64.17. But by February 23, 2026, it had plummeted 32% year-to-date, dropping all the way down to $43.94. This is being driven heavily by institutional investors actively de-risking as they finally wake up to the sheer cash flow strain and the general cyclicality of the private markets.
So here is the brutal truth for our committee today. A 30% discount to a negative intrinsic value is still a negative number. Because of that, a quantifiable margin of safety simply does not exist for this asset today. I mean, you just can't confidently buy a dollar for 70 cents when you can't even prove the dollar exists in free cash flow to begin with.
Bringing us to Section 5, our final Buffett-style verdict. As this quote from the financial analysis perfectly summarizes, the sheer accumulation of assets under management, hitting that staggering $132.8 billion mark, is basically just a vanity metric if it structurally fails to generate owner earnings. Scale on its own is simply not fixing their bottom line.
Let's bring it back to Buffett's gold standard, buying a wonderful business at a fair price. That definition requires a durable economic moat, generating high returns on capital, purchased at a discount to intrinsic value. StepStone completely fails this definition. Based entirely on the documents provided to us, it is a cash-burning business selling at a price that is built entirely on the hope of future margins, rather than any current hard fundamentals.
So, our final objective verdict directed to this value investment committee is a definitive pass. The moat just lacks proven pricing power. The quality of the earnings is deeply unprofitable with alarming negative operating leverage. The valuation gap offers exactly zero margin of safety due to that negative $7.01 EPS. Our final conclusion: this is a textbook value trap. Do not allocate capital to this at this time.
The super sleek exterior of private equity data partnerships, these LSEG integrations, and massive AUM, it's really just hiding a fundamentally broken machine that, at least on its current trajectory, is actively destroying shareholder capital. And that leaves us with a pretty critical and provocative thought to end our meeting on today. If the architects of private market capital, operating at an unbelievable scale of $132 billion, cannot manufacture a profit for their own public shareholders, how safe is the private ecosystem itself that they are relentlessly selling to the public? Something to chew on. Thanks for joining me for this explainer, and I'll see you all at the next committee meeting.